Earnings. Jonathan Camarda. Hopefully you guys are all staying warm. As we move through mid-January, we've had a little bit of a positive uptrend with an overall downtrend within the S&P and NASDAQ. Dow Jones value stocks are above their downtrend line as, again, tougher economic environment has created, again, a reinvigoration of balance sheets, income statements, and cash flow statements of companies. And we'll get into the delineation between the strategies and the coverage there. Overall, we have an inflationary environment that is persistent. However, we've had a little bit of letting up here. If you look at gas prices, Treasury yields, and the U.S. dollar, all going down, which has created a little bit of a respite and some upside for equities, at least in the short term. Now, the Fed continues on their march and certainly has a mandate, at least as far as they're concerned, to get inflation to the low 5% range, or rates to the low 5% range, to, again, get to that 2% inflation rate. He meant to say. So again, with that being said, in February, again, the probabilities are they're still looking at 0.25%, which is lower than the last several, of course, but still an upward trajectory. Now, that is on the precipice, of course, as we've been talking for months, a rolling recession across the economy. So again, with the inflationary fight that we see, we also see an extreme slowdown in manufacturing, car sales, home prices and home sales, all going down, as well as real wage growth. And we talked about the employment numbers that many on the press say are persistent. However, if you look at the smart companies out there, these large tech companies, and even now you see some of these financial firms, to be named, not on this program, are all cutting jobs. And they don't do it all at once, right? They start to do it thousands here and thousands there, and they just trim. All because they see the slowing there. You see companies also subleasing office space, especially those that increase their real estate footprint post-COVID. So what does this mean? Well, market-wise, if you look at last quarter, not too bad with the finish. Even with that rough finish in December, we had a Santa Claus rally. So as you look at your last quarter, not too bad. And also the last 6 months, if you look across strategies, pretty good risk mitigation there as well. Through, if you can remember, as far back as the August Fed meeting and that harsh downturn from August to October. If you look across strategies there as well, you'll be pretty pleased there with risk management tactics. Now, the one thing I'll say is a lot of folks, as you go from 22 to 23 and you reflect on last year, a lot of people tend to reflect on, what index did the best? And certainly that's human nature return-wise. But remember, while you're going through a process, again, and markets are moving, you cannot control your returns. And you don't want to make decisions based upon what did the best, certainly last year, or saying, that index did better, because, again, you cannot control returns and performance. Much like weather, you have to dress accordingly. You can control risk management and risk exposure, much like dressing, depending on the weather. Whether in Alaska or Hawaii, you can dress, but you can't change the weather. From that standpoint. So if you look at last year, for example, the market and the index, rather, that held up the best among the major three was the Dow Jones. Of course, many would look at the Dow Jones and say, well, it's really not a barometer of the economy or the stock market, being it's 30 companies, and it's price weighted. What does that mean? Well, if my company's worth 500 shares and yours is worth 50 a share, and my company goes up 10% based upon something totally has nothing to do with the economy or your company, that index can really jump, which is misleading on a market or economic standpoint, because, again, it's much like a orca jumping into a pool in SeaWorld versus a salmon, which is going to cause the biggest splash, right? But that doesn't necessarily reflect the entire ecosystem of that pool. Now, I know that I don't think there's orcas anymore in SeaWorld, but call me nostalgic from that standpoint. So what I'm trying to say is, again, is you always want risk management and your own personal risk appetite to, again, dictate your exposure, and certainly talk to your PWAs as far as tweaking that. So if you look across strategies like last year, active capital preservations, which hung in real well even through the fixed income drop, is active, but with a conservative tinge. Last year using alternatives and metals certainly late in the year, and now fixed income, which has been attractive with the aforementioned declining yields, and then an opportunistic growth in income relative to some of the more aggressive strategies, even though is more diversified and certainly has a larger bandwidth from a fundamental standpoint than just the Dow Jones was more in line with the Dow Jones than, let's say, a global macro or velocity raptor. But again, the key is to look at the long term, your risk appetite, your need for capital, understanding that market corrections are defined between 10 and in the upper teens, 15%, and some define it even less than 20% because a bear market's considered 20% or more drop. So with that being said, if you go into a market correction between 10, 15% or so, and if you sell everything out at that point, say, well, getting out there in the middle of a correction without a defined bear trend, then if the market does jump to the upside and you are a more aggressive investor, but you wanted to play quick defense, and then let's say the market rebounds all the way up and is now +2, you locked in at a 10% loss or 15% loss, again, that is not a good feeling to have. So it's always a shade of gray in managing that risk. So as you look at risk and returns, you have to say to yourself, well, what is my individual risk appetite? And then also discuss the mix of strategies with your PWAs because, again, you're the boss. So if you want more of a mix that is more tactical, certainly, in certain environments, although realizing that in uptrends might not make as much as the strategies that hang in a little bit longer, then that trade-off has to be discussed and you're just in a better position. With all that being said, however, if you look at what markets did, especially during some volatile times as a whole across your sleeves and across strategies, on a risk management standpoint, many clients are pleased with that because when they realize, okay, how much risk was I taking? Where were the absolute extremes of the returns and how much did I participate in those? Not a bad scenario. Again, any more detailed granularity, certainly for your PWAs, don't want to steal their thunder, but did want to give a macro top-down as a CIO and certainly having some very loyal clients for multiple decades myself. With that being said, enjoy your football. By the time you're watching this, you probably may have already watched all the games, or at least hopefully your team won if they are in the playoffs. Again, Jonathan Camarda here, feeling a little bit more like Dr. Freeze, signing off. So again, stay frosty. That won't be hard. And until next time, we'll see ya.